If you are over the age of 65 and filing your taxes this year, there is a very high probability that you are handing the Internal Revenue Service thousands of dollars that legally belong in your pocket. Right now, in 2026, the tax code for retirees has fundamentally changed, yet the vast majority of seniors are still filing their returns using the exact same outdated strategies they used during their working years. This oversight is silently draining retirement accounts across the country. Today, I'm going to walk you through 5 specific tax breaks designed exclusively for seniors that most people completely miss. In fact, the final break I will show you is a brand new, massive $6,000 deduction that was just introduced. And if you do not know exactly which box to check, the IRS will absolutely not give it to you automatically. When you transition into retirement, the way the government taxes you flips upside down. You shift from living on earned income, like a salary or wages from a business, to surviving on a fixed income composed of Social Security benefits, pensions, and mandatory withdrawals from your retirement accounts. This shift requires a completely different defensive playbook. Over the years of analyzing tax strategies and helping people protect their hard-earned nest eggs, I have seen too many retirees forced to cut back on essential expenses simply because they overpaid the government on April 15th. My goal today is to give you the clarity and the exact mechanical steps you need to lower your tax bill and protect your savings. We are going to cover a powerful hidden standard deduction bonus, move into a highly misunderstood tax credit that most accountants ignore, explore how your routine medical expenses can legally shield your income, break down a strategy to eliminate taxes on your mandatory retirement withdrawals, and finally, reveal the massive new $6,000 deduction that every single retiree needs to know about this year. Let us dive right in. We are starting with one of the most reliable yet frequently overlooked foundational tax breaks for retirees, the Additional Standard Deduction for seniors, often referred to as the Age-Up bonus. Most taxpayers understand the general concept of the standard deduction. It is the baseline amount of income the IRS allows you to earn completely tax-free before you even have to think about itemizing your deductions. For the 2026 tax filing season, the baseline standard deduction for a single filer is $15,750, and for a married couple filing jointly, it is $31,500. However, what millions of retirees fail to realize is that the moment you turn 65, the IRS quietly grants you an additional deduction on top of that baseline. They do not advertise it, and if you are filing your taxes by hand or using basic software without paying close attention to your profile settings, you will miss it entirely. If you are single or file as head of household, you are entitled to an additional $2,050 subtracted from your taxable income. If you are married and filing jointly, you get an additional $1,650 per qualifying spouse. That means if both you and your spouse are 65 or older, you get an extra $3,300 knocked off your taxable income automatically. Let us look at how this physically works on your tax forms. In 2019, the IRS introduced Form 1040-SR, a specialized tax form designed specifically for seniors. At the very top of this form, there are checkboxes next to your name and your spouse's name, asking if you were born before January 2nd, 1962. Checking this box is the mechanical trigger that tells the IRS computing system to apply your Age-Up bonus. Now, there is a very peculiar quirk in the tax code that trips up thousands of seniors every single year. The IRS has a unique legal definition of when you actually turn 65 for tax purposes. According to the tax code, you are considered to have reached age 65 on the day before your 65th birthday. This means if your birthday falls on January 1st, you are legally considered to be 65 on December 31st of the previous year. Therefore, you qualify for this extra deduction a full year earlier than you probably thought you did. I cannot tell you how many times I have seen retirees leave this money on the table because they assume they had to wait until the following tax year. You must be proactive here. If you use a commercial tax software, go into your basic information settings and verify that your date of birth is entered perfectly. The software is programmed to calculate this automatically, but a typo in your birth year will cost you hundreds of dollars in unnecessary taxes. If you use a professional tax preparer, explicitly ask them to confirm that your additional standard deduction has been applied. Do not assume they caught it. Advocate for your money. Moving on to our second break, we have a provision that provides some of the most dramatic tax relief available, yet it remains one of the least claimed provisions in the entire tax code: the credit for the elderly or the disabled. To understand why this is so powerful, you first have to understand the fundamental difference between a tax deduction and a tax credit. A tax deduction reduces your taxable income. So if you fall in the 22% tax bracket, a $1,000 deduction saves you $220. But a tax credit is a dollar-for-dollar reduction of your actual tax bill. If you owe $4,000 in taxes and you receive a $3,000 tax credit, your tax bill instantly drops to $1,000. It is direct, powerful money in your pocket. The credit for the elderly or the disabled ranges from $3,750 all the way up to $7,500, depending on your income and your filing status. However, the reason most people have never claimed a single dollar of this credit is because of how restrictive and complex the qualification thresholds are, and because it requires filing a completely separate form called Schedule R. Most people do not even know Schedule R exists. To qualify for this credit, you must be 65 or older by the end of the tax year. The primary hurdle is the income limitation. This credit was designed specifically to protect low to moderate income seniors who are surviving on fixed pensions and limited Social Security benefits. If you are an individual filing as single, your adjusted gross income, which is found on line 11 of your Form 1040-SR, must be less than $17,500. Furthermore, the total of your non-taxable Social Security, pension, annuity, and disability income must be less than $5,000. If you are married and filing jointly, and both you and your spouse qualify for the credit, your combined adjusted gross income must be less than $25,000, and your non-taxable income must be less than $7,500. I want to pause right here and share a staggering reality with you. Millions of seniors who have modest incomes completely forfeit this credit simply because they think they do not make enough money to worry about complicated tax forms. They file a basic return, pay a few $100s in taxes that they scrape together from their fixed income, and move on. If you or your parents are living on a modest fixed income, you must pull up Schedule R. The IRS formula used on Schedule R will calculate your base amount, subtract your non-taxable Social Security, and then subtract a portion of your adjusted gross income to arrive at a final credit amount. Because this credit is non-refundable, it will not generate a giant refund check if it exceeds your tax liability, but it will legally wipe out your tax bill down to zero. That means every single dollar of your pension stays in your bank account where it belongs. Our third major tax break involves a strategy that most retirees abandon far too early: the medical and dental expense deduction. Ever since the standard deduction was drastically increased a few years ago, the conventional wisdom has been that itemizing your deductions is a waste of time. For younger, working-class families, that is largely true. But for seniors over 65, medical costs skyrocket, and those costs can be strategically used to legally shield massive portions of your retirement income from the IRS. The rule states that you can deduct qualified medical and dental expenses that exceed 7.5% of your adjusted gross income. To figure this out in plain English, you simply multiply your adjusted gross income by 7.5%. That resulting number is your threshold. For example, if your adjusted gross income is $50,000, 7.5% of that is $3,750. The IRS says that the first $3,750 of your medical bills are your responsibility. But every single penny you spend on qualified healthcare above that threshold becomes a tax deduction. If you had $15,000 in medical expenses that year, you would subtract your $3,750 threshold, leaving you with a massive $11,250 deduction. Here is where the tragedy occurs. Most seniors think medical expenses only mean hospital bills or co-pays at the doctor's office. They look at those receipts, see they only spent $1,000, and give up. What they do not realize is that the IRS allows a massive umbrella of expenses to count toward this threshold. Did you know that your Medicare Part B premiums, the ones that are automatically deducted from your Social Security check before you even see the money, count as a deductible medical expense? What about your Medicare Part D prescription drug plan premiums? Those count too. Supplemental Medigap insurance premiums? Absolutely. Beyond premiums, you can include out-of-pocket costs for dental work, which Medicare famously does not cover. If you paid $10,000 for dental implants or dentures, that goes directly into your calculation. Hearing aids, eye exams, prescription glasses, and even the travel expenses, the mileage you drive back and forth to your medical appointments, all count. For 2026, the IRS allows you to deduct a specific cents per mile rate just for driving to the hospital or the pharmacy. Furthermore, if you are forced to make home modifications to age in place safely, you can include those costs. Installing safety grab bars in your shower, widening doorways for a wheelchair, or building an entrance ramp are all considered deductible medical expenses, provided they do not purely increase the aesthetic value of the home. The secret to maximizing this break is a strategy called bunching. If you know you need a knee replacement and expensive dental work, do not spread them out over 2 tax years where you might miss the 7.5% threshold in both years. Instead, bunch those procedures into a single calendar year. By stacking your Medicare premiums, your out-of-pocket costs, and a major procedure into one 12-month window, you violently blow past the 7.5% threshold and generate a deduction so large that it surpasses the standard deduction, shielding your retirement withdrawals from taxation. We still have the absolute biggest tax break to cover, the new $6,000 deduction that was just signed into law, which is fundamentally changing the game for retirees in 2026. I will break down exactly how to claim it and calculate your limits in just a moment. But first, we absolutely must address a devastating trap that catches seniors who are forced by law to withdraw money from their retirement accounts. As you progress through your retirement, you eventually hit an invisible tripwire in the tax code known as Required Minimum Distributions, or RMDs. Once you reach age 73, the IRS looks at the tax-deferred money you have been saving in your traditional IRAs and 401ks for decades and decides they have waited long enough to collect their taxes. By law, you are forced to withdraw a specific percentage of that money every single year, whether you need the cash to live on or not. If you fail to take this distribution, the IRS will hit you with an aggressive penalty on the amount you were supposed to withdraw. Here's the problem. When you are forced to pull that money out, it is added directly to your adjusted gross income. This artificial spike in your income creates what financial planners call the tax torpedo. This sudden influx of taxable income can push you into a higher tax bracket. It can cause up to 85% of your Social Security benefits to suddenly become taxable, and it can even trigger higher Medicare premiums simply because you took your mandatory withdrawal. This is where our fourth tax break, the Qualified Charitable Distribution, or QCD, becomes an absolute lifesaver. If you are charitably inclined and you give money to your church, a local food bank, or any registered charity, you are likely writing them a check from your personal bank account. Under the current tax code, because the standard deduction is so high, you probably get zero tax benefit for that donation. A qualified charitable distribution allows you to take up to $111,000 directly from your IRA and transfer it straight to the charity. The magic of this strategy is that you are allowed to start doing this at age 70 and a half, long before your forced distributions begin. But more importantly, when you use a QCD to satisfy your required minimum distribution, that money never touches your adjusted gross income. It is completely legally excluded from your gross income. You bypass the tax torpedo entirely. Your income stays low, your Social Security benefits remain protected from taxation, and your Medicare premiums do not go up. Plus, you still get to take the massive standard deduction we talked about earlier. It is the ultimate double dip in the tax code. However, the execution of this strategy must be flawless. You cannot withdraw the money into your personal checking account, let it sit there for a week, and then write a check to the charity. If the money touches your hands, the shield is broken, the income is realized, and you will be taxed. You must instruct your IRA custodian, whether that is Fidelity, Vanguard, Schwab, or your local bank, to draft the check payable directly to the charity. Furthermore, you must protect yourself when filing Form 1040-SR. When your broker sends you your tax forms at the end of the year, the form will just show a normal distribution. The IRS computers do not automatically know it went to a charity. When filling out your 1040-SR, you must report the total distribution on the correct line, but on the taxable amount line, you enter 0. Next to it, you must physically write the letters QCD. If you or your accountant forget to write those 3 letters, the IRS will tax you on the entire amount. Be fiercely protective of this step. Finally, we have arrived at the most critical update for the 2026 tax filing season. If you take nothing else away from this presentation, hear this clearly. In July of 2025, Congress passed the One Big Beautiful Bill Act. Buried within this sweeping legislation is a massive temporary tax break specifically designed to shield seniors from the crushing weight of inflation. It is a brand new, enhanced senior tax deduction, and it is available starting right now for your 2025 returns filed in early 2026, running through tax year 2028. This is not a replacement for anything we have discussed. It does not replace your standard deduction, it does not replace your age-up bonus, and you can claim it even if you choose to itemize your medical expenses. This is an additional standalone deduction that stacks directly on top of your existing tax breaks. If you are 65 or older by the end of the tax year, you are eligible for an additional $6,000 deduction to completely remove that income from taxation. If you are married and filing a joint return, and both you and your spouse are 65 or older, you get a combined $12,000 deduction. When you combine this new deduction with the standard deduction and the age-up bonus, a married couple over 65 is suddenly looking at nearly $48,000 of completely tax-free income before they pay a single dime of federal income tax. The primary goal of this legislation was to functionally eliminate federal income taxes on average Social Security benefits, and for millions of retirees, it does exactly that. However, the IRS is not simply handing this out to everyone. There are strict income limitations known as phase-outs that you must calculate perfectly. The government uses your modified adjusted gross income to determine if you get to keep this deduction. For a single filer, the phase-out begins when your income crosses $75,000. For a married couple filing jointly, the phase-out begins at $150,000. If you make less than those limits, you get the full $6,000 or $12,000 deduction. But if you make even $1 over those limits, the deduction begins to systematically dissolve. The rule is simple. For every dollar you are over the threshold, you lose 6 cents of your deduction. Let me walk you through a practical example of how this calculation works in the real world. Suppose you are a single retiree. You are 68 years old, and you had a fairly good year. Between your Social Security, your pension, and a required minimum distribution, your modified adjusted gross income comes out to exactly $80,000. First, we determine how far over the threshold you are. Your $80,000 income minus the $75,000 limit leaves you exactly $5,000 over the limit. Next, we figure out your reduction. You multiply that $5,000 overage by 6 cents, which gives you $300. This $300 is your phase-out reduction. Finally, you subtract that reduction from your maximum $6,000 deduction. $6,000 minus $300 leaves you with a final, legally allowable deduction of $5,700. Even though you were over the income limit, you still get to permanently shield $5,700 of your income from the federal government. If you are single, this deduction is completely wiped out once your income reaches $175,000. For married couples, it is wiped out at $250,000. The danger here is complacency. Because this law is so incredibly new, thousands of commercial tax software programs and even seasoned accountants who are operating on autopilot are going to miss it. To claim this, you do not have to fill out a complex application, but you must ensure your Social Security number is correctly entered, that your birth date establishes you are 65 before the end of the year, and then if you are married, you are filing a joint return. Married individuals filing separately are heavily penalized and face immense difficulty claiming the full benefits of this law. When you sit down to review your tax return this year, before you sign on the dotted line, you must demand that your preparer show you exactly where the One Big Beautiful Bill senior deduction has been applied. If they look at you with confusion, you need to halt the process and direct them to the new 2026 IRS guidelines. No one cares about your money more than you do, and you must act as the ultimate auditor of your own wealth. We have covered an immense amount of ground today, and I want to briefly recap the 5 protective barriers we have built around your retirement income. First, ensure you are claiming the Age-Up Additional Standard Deduction just for turning 65. Second, if you live on a modest fixed income, investigate the dollar-for-dollar power of the credit for the elderly or the disabled using Schedule R. Third, do not ignore your medical expenses. Bunch your Medicare premiums and out-of-pocket costs to breach the 7.5% threshold. Fourth, protect your Social Security from the required minimum distribution tax torpedo by utilizing qualified charitable distributions directly from your IRA. And finally, fiercely defend your right to the brand new $6,000 senior tax deduction enacted for this exact tax season. Navigating the tax code in retirement can feel isolating and overwhelming, but you do not have to do it blindly. I want to hear directly from you. Which of these 5 tax breaks were you entirely unaware of? Have you ever had a tax preparer completely miss your Medicare premiums, or fail to mention a qualified charitable distribution when you were forced to withdraw money? Leave a comment below and share your experience. Your story, your frustration, or your success might just be the exact warning another retiree needs to read to save themselves from making a devastating and costly mistake on their return this year. Thank you for taking the time to educate and protect yourself. And please, take care of your family and your hard-earned money.